Perfect.
Thanks to the organizers. It's a shame I'm not there. Boston is having a gloomy, rainy, sad day. I'm hoping maybe you have a more sunny day than we're having here. Okay, so capital flows are volatile. This is some data that I downloaded from Brazil. The Brazilian website allows very easily to download capital flows data. Here you can see portfolio investment. It does show monthly net inflows, outflows, but what is clear is volatility. So the questions this paper poses is, should we distinguish these transitory fluctuations from some medium-term fundamental movements? And I would argue that yes, this is important. I do think as policymakers, having an idea of benchmark is important. And then can we do this? And the answer to these questions from this paper, yes, we should and we can. And so what they do is that they present a measure, as was very clearly explained by Frank, that is slow moving, is supply-based benchmark. It's mostly thinking about the medium-term horizon and will help us get a sense of where we expect capital flows to be for a country. As he stressed, is theory-based. He mentions a couple of papers, Thailand Van Winkop and Devereaux and Sutherland. And again, as I said, is mostly thinking about medium-term. It's also easy to construct. And so he uses lag portfolio weights from Lane and Milesi Ferretti and a current savings from the IMF. The paper is very honest. It uses 5 lags. That part is a little bit ad hoc, but it's the best fit of the data. Does it work? Yes. And he showed the examples for different countries. And one can see that this measure does give you this trend for different countries. The paper does perform horse races with different techniques, and he does find that they do perform, the measure does perform great. It performs best around 1 to 2 years horizon. And as he mentioned, it can explain close to 40% of medium run variation, which outperforms some other measures that we have and traditional push-pull factor regressions. The paper advances applications, and I think this is the most useful part for policymakers. It helps build the early warnings toolkit using previous type data and regressions that he has done in the work of with Christine Forbes. He does show that this measure is very good at explaining, in particular, stops. I'm actually not shocked that it doesn't explain as well surges. I think it does a great job with stops, and as he explained, it's going to be the probability of a sudden stop when one sees as one standard deviation above the mean is close to 30%. So it's a very strong predictor of a crisis. He also has an application where it's also a leading indicator of changes in prices. So again, he does show that the gap can predict close to 10% reductions in equity returns. And he also showed, which I thought was very interesting, is that it does show that some of the changes in capital flows related to the pandemic were transitory. If you all recall, around March, April 2020, in emerging markets, we were all very worried because capital flows were all leaving. And we found out again that it was not as bad. It is possible also that all the policies implemented meant that capital flows transition back. But again, that it does come from his measure that it would have been a transitory shock. So clever and useful, I think it's on brand. Frank has a tendency to do this very clever and very, as I said, great for policymakers type papers that provides us a lot of insight, but it also helps us build a toolkit. So my suggestions, I would say, are a little bit unfair because they go away from the setup of the paper, the paper wanted to be easy to implement. So some of these suggestions are going away from that easiness, but maybe some of these will increase the fit. Some comments on the theory, the sources of these changes in the supply side, some comments on weights, what about fundamentals? Again, some of these comments are mixing theory and data, some comments on recent data and trends. If the measure is the natural level of capital flows, should we expand to all capital flows, not just portfolio? And for future work, I think Frank is the right person to think about China. So one little comment, as you all know, and this is also why I wanted to start with that graph from Brazil. If you look at the graph, it does suggest that there was a huge increase of volatility around 2010, and some of that is true. But also around that time is when countries started to adopt the new balance of payments methodology. Not all countries adopted it the same day. Not all countries had the right data to implement them. So someone with a little bit more patience one day has to go and talk to all policymakers and get the information of what were the changes that they adopted and how they changed the perceived volatility in the data. The Brazilians, for example, are very good, and they have a website where they say what are the changes that they adopted, which ones didn't, but some of these make volatility look worse than before. And again, one of the issues is not all countries adopted it at the same time. So we may be inferring things that are just due to some data change. And again, it's probably a lot of work, but it would be good if someone documents all of these changes because they do correlate around the crisis period. So let me just go back to the paper does mention the Thailand Van Wickup, as I said, as a background theory. It's a two-country model, exogenous AR1 productivity process. There is consumption bias to map the fact that there is a home bias. There's incomplete financial markets, uses an iceberg cost, which is standard in a lot of this literature. And so agents are maximizing wealth by allocating the portfolios between home and abroad, equating returns. One paper that has the same flavor that is not mentioned, but it's also has similar implication is the series of papers by Cray and Ventura, and also one co-country portfolios by Cray and Loaiza and Serven. Again, in this case, is two assets, a risky domestic capital, a riskless foreign bond. There's a transitory small income shock. The optimal share means that you keep the foreign bonds constant. So when you get a shocking wealth that would be given by savings, you invest like the current situation. In their follow-up, they adjust to match short-term flows versus medium-term flows. They put an adjustment cost. So first money goes out and then it slowly comes back because you cannot increase domestic investment as fast. But it gives you the same flavor. Both of these papers have the same decomposition. The portfolio growth, which is the size of the pie, and the portfolio rebalancing, if you want, is the slices of the pie now that we're heading into Thanksgiving. And so the portfolio growth is given by the increase in savings, and the slices of the pie, the rebalancing, is by the reallocation of expected returns and risk. So one thing about these papers, if you go back and read them, they were very complicated to solve. In fact, both of these papers have a very large methodological section. The way the Art and Cray and deal with this, the Cray and Ventura, deal with this is that it's a partial equilibrium, restricts investment opportunities, and has transitory shocks to make it easy to solve. But again, the idea behind these papers is complex. And so this decomposition is a little bit by design or methodological reasons, not looking at valuation effects. It's just looking at portfolio growth and rebalancing. So some questions, again, deviating from the simple, would the fit improve if they try to differentiate savings shocks, government savings versus productivity shocks? And again, this is driven by a defense, so perhaps thinking of the different savings shocks would improve the fit. Again, what would be the role of valuation effects. And the other one is, if you read these papers, it gives you more of a sense that bilateral data would be a better fit. And again, I know there's less data, but that's something to think about. When you look at the weights use the famous Lane and Milesi, an important contribution to international. As you know, the data is using either direct estimates or indirect ones that are just an accumulation of flows. So the stocks of the different holdings are just evaluated due to changes in the prices of the previous year's stock, plus the current flow. And so if the stock is the sum of flows and we're using five last weights, then the measure is a convex combination of different sets of lags of capital flows for different countries. And so one wonders if the reason why this method is outperforming the Hamilton method is because the difference is these valuation changes. And again, that is just perhaps a check just to try to see if we can understand a little bit how to improve the fit. And again, Frank showed this, the changes in some of these allocations. When you see some of these countries, you worry a little bit. I mean, China is fine, but then also you see Guatemala and Sri Lanka, and fair enough, these were changes, but perhaps thinking of some of these weights, again, may help us improve the implications. Let me regress a little bit. This is data that I got from one paper. She looks at different volatility of capital flows in emerging markets and advanced economies, starting in the year 2000. And so as we know, capital inflows tend to be actually a little bit less volatile than capital outflows. And it is not the case that emerging markets are more volatile than advanced economies. And again, it could be the role of policy, but in general, it's not the case that emerging markets are more volatile. As we all know, FDI inflows and outflows tend to be less volatile than portfolio outflows and inflows. But again, for example, portfolio inflows are more volatile in advanced economies, outflows more volatile in emerging markets. And as Helen Ray mentioned in her discussion, bank flows win. They tend to be the most volatile. And so as the name of the paper is capital, the natural capital flows, shouldn't we be thinking about all of these flows? And are these volatilities interdependent more than independent? And again, firms tend to have complex activities, and they do tend to use all of these forms of capital flows. As you know, you don't want to get into a country that you don't want to get out, but once you're in, you might come in as portfolio, but you may need trade credits, and you might need bank, and so on and so forth. So it becomes a mixture of all of these flows. And as was mentioned, there are these changes in capital mobility. This comes from a BIS document. There is a decline in banks, moving to shadow banking. There's also the complex ways that multinationals finance themselves. Some of it is related to the increased role of risky assets in tax havens due to low interest rates and regulation, but also multinationals have become extremely complicated. So again, they may just be reshuffling one capital flow for another one. So it may matter for the measure, it may matter for volatility. This is data from a paper that is using the US big data. This is actually the public data that looks at these two-way flows, US against Cayman Island, that has become the #1 place for the US assets and liabilities. And when you see the composition of flows, you do see a lot of these round-tripping asset-backed securities, buying again asset-backed securities, and so on and so forth. So a lot of this is this intermediation in tax havens and financial centers. What about derivatives? This is work that I have been doing with Mauricio Calani and Liliana. They are there to try to deal with this volatility the way we were recording them before. after the changes in the balance of payments, now they get their own line. But again, they may be a way to try to reduce this volatility, which just goes back to the comment that a lot of these capital flows may be complement more than necessarily independent. And if we're thinking about all capital flows, then perhaps, again, in a different paper, they might want to think a little bit, or a measure that is not only supply driven, but also looks at some of the fundamentals. There's this nice paper by the IMF that does show that once you start thinking of other capital flows, and once you start thinking beyond the quarter or the monthly, you do start seeing an increasing role for fundamentals. Finally, and again, for a different paper, what about China? As we know, the role has been increasing. There is a nice paper by Grace Wu and Eswar that does look at the determinants of China's international portfolio equity. They use a benchmark to try to think of how to do it. But as Carmen Rein has documented, we do know that they're lending to many countries, and these debts and flows are hidden, and so it may affect some of the measures that we're using. But again, great paper, must read.
Thank you very much, Laura. I don't see any questions yet, but perhaps Frank, you might want to take some of the issues that Laura raised.
Sure. Yeah, I'd be happy to, and I will actually try to. Let's see. I was going to try to share my screen again, but okay, yeah, here it is. So I'm going to share my screen just one more time, just because I have a couple additional slides that will just address some of the things. And so, can you see that? Yes, right? Yeah. Okay. Good. Okay. So so Laura. So thank you, Laura, for the comments, and many of them we've thought about. And so this one slide I just want to show, if we build up a bilateral measure, right? So you mentioned that there's a cleaner mapping into a bilateral measure from the theory. Then we'd have to rely on the CPIS data, but then there's still holes, right? So if we go forward, so if we say here we are in 2021 and we want to go forward, the quality of the bilateral data has improved greatly, and so maybe we can. But for a historical measure, there's been many holes in the past, and so we tried that, but there's just too many gaps. Let's put it that way. We've also tried, CAPM based measures, but you run into the home bias, and so that's another issue. The why don't we look at FDI and banking flows? We fully believe that somebody should, if we want to try to stay as close as we can to the theory and map to the practical measure. It's really much more about portfolio investment rather than where firms decide to set up shop, right? FDI. And do I think that somebody should take this on? Yes, absolutely. To be clear, we're not going for the best fit, right? So we're not doing that at all. So we do want to be simple and useful. So for example, we want the government of Papua New Guinea to be able to take this measure and gauge where they think capital flows are going to be in the medium term. We don't want something overly complicated, but this is a first attempt, right? And we fully, if you think back to the literatures on core inflation, on R-star, et cetera, we fully expect people to come up with other measures, and some of them better than ours, and we think that's a good thing. So we're really just trying to make the point that, wow, capital inflows, portfolio inflows do seem to oscillate around some natural level, and we put forward one such natural level, and there could definitely be other ones. There'll be other estimates. Other researchers will come up with other estimates. We're fine with that. The only other thing I'll say about the Lane-Malesi-Ferretti data, Laura, you're absolutely correct that when they say that some of their estimates of holdings or positions are accumulated flows with valuation adjustments, that holds more for, I think, the first wave of their data set. The second wave, I think almost all the countries that we have in our sample actually measure these things, and that's where Philip and Jean Maria go to the measured positions. And for a couple countries, sure, they still have to do estimates, just because the measured ones don't exist. But you can see in their metadata how many countries those are. I'll stop there for now. I can keep going, but are there other questions?
Thank you, Frank. Just one comment. I haven't seen any questions yet, but in the case of countries like ours here in Chile, where natural resources play such a big role, and these are more related to FDI than portfolio, even though there is a strong correlation sometimes between portfolios and FDI, but we have seen similar patterns in the sense that, well, commodity booms and boosts tend to be cyclical, so there is some mean reversion after all, so it makes some sense. It's just wanted to make the point. We have one question here by Andres Fernandez. Andres?
Hi, Andres.
You are on, Andres.
Joaquin, thanks, Frank. Very interesting paper. So I have a question or a comment. So one puzzling, I would say, finding is that it's mostly supply, right? It's very little about demand. So not too much role for pull factors, I would say. I wonder if you agree with that. But at the same time, you say that the model does not capture well these capital flows bonanzas, right? I wonder what would happen, or if you have tried controlling for expectations, market expectations of domestic growth. So what would happen if you were to include market expectations about growth in EMEs, right? And in a particular country, would that improve? Would that give you an edge to capture these bonanzas?
So, so to be clear, so when flows are below KF star, does it accurately forecast that they're going to bounce back to KF star? Yes, right. So it does actually. There's no asymmetry in that effect. What it doesn't predict are these capital flow surges, which, to be clear, are flows that are 2 standard deviations above the historical mean. So that those extreme episodes on the upside, it doesn't predict well. But if you have depressed flows, it does correctly predict that they're going to bounce back to a normal level that we would call the KF star, but just not to an extreme amount. The asymmetry is when you have very, very high capital flows relative to KF star, and there's strong global growth, so KF star is increasing, then you are likely to have these an extreme drop in capital flows. And so that's the asymmetry. It's really about the extreme episodes. Now, could we, so Laura brought up points like this, and Andre, you are as well. Could we do better with some things going forward? Absolutely, absolutely. So we're trying to put forward plant the seed that yes, capital flows seem to oscillate around some level, and so that's just useful for us to think about no matter what. And then what is that level? Different people will have different ways of constructing that. Ours is supply side, but you can. I truly hope so. At the beginning of Laura's discussion, she said that we try to be useful with our work. I really do want to be useful with this. I don't want to have the best measure out there. I want the best measure to evolve and others to run forward with this. And so I think a lot of the suggestions Laura made and what you're saying, Andre, yeah, those are, the measure might be improved. pretty happy right now with this one, supply side. I think about it a lot like I think about CBO's estimate of potential GDP. Could we come up with other measures of like the natural rate of output in the US and elsewhere? Yeah, of course we could. And I look forward to that.
Thank you very much, Frank. I think we're right on time.
All right.
So thank you very much, Frank, Laura. Very interesting paper, actually. I think it's, to me at least, as a practitioner, it looks very attractive as an approach to start thinking about these things. And thank you very much for the presentation and comments.